Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 26th of February. I'm Daniel Lam, your host for the podcast. Looking across our level 1 assets, it seems that gold, compared to equities or fixed income, is relatively flying under the radar for now. But we do believe it is good to accumulate between the 1950 to the 2000 levels. So the first critical variable is the demand from China and India. Now, we continue to expect that the Fed is going to start cutting rates in its June meeting. Now, as real rates come down, we expect a down leg in the US dollar to follow and assets ex-US to become more attractive. So this will be supportive of gold prices, and it is likely to spur physical demand in the two largest gold markets in the world, which are China and India. Now, in China, as a result of the deflationary pressures, households are driven to increase savings. So, combining with low interest rates, households ramped up gold bars and corn investments by 28% in 2023 due to its ability for value storage. Now, for India, we're also expecting physical gold demand to pick up as economic growth ticks higher. Now, in its latest global economic growth outlook, the IMF expects GDP growth in India of 6.5% this year and the next year. And that was an upward revision to the fund's last forecast. Now, despite domestic gold prices setting price records last year, Indian gold jewelry demand declined only by 6% year-on-year, relative to a very strong 2022, as per the World Gold Council. Bar and corn investments in India grew 7% year-on-year, as buyers took advantage of a price correction which occurred in the third and fourth quarter in 2023. Now, bullish Indian economic growth next year will translate into higher household spending and hence gold demand. Now, the second key factor is gold purchases by central banks. Now, we expect that to continue as they diversify away from US dollar foreign reserves, and also because of the elevated geopolitical risk arising from the Russia-Ukraine war and the ongoing conflicts in the Middle East. Central banks' gold purchases continue to be very high in 2023, with net purchases hitting 1,037 tons, only 45 tons shy of the 2022 record. And lastly, global economic policy uncertainties will also keep a bit for gold, as war and the threat of war and the manner in which governments pay for arming themselves, for example, expanding fiscal deficit, all these move to center stage over the medium to long term. Households fearing currency debasement also would like to hedge against inflation risk as states prepare for potential conflict. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.